So Melbourne, like look at it from a numbers point of view and you go, well, this is crap, right? It's not growing. It's had very low growth over the last few months. Why would I want to buy there? But we need to look at and understand that each property market moves in a cycle. So Melbourne is what we would call early cycle. It's, in my opinion, mispriced in certain markets. Hey everyone, welcome back to the Smash Property Podcast. This week's episode is the December property market update, and I'm telling you, this one is a juicy one, packed full of insights. If you're new, my name is Nick V, and I'm the founder and director of the Smash Property Investing Buyers Agency, where we primarily only focus on building property portfolios for our clients. And every month we put together a property market update from what we are seeing out there from a data point of view, but also importantly, what we're seeing out there with boots on the ground out there in these particular markets. So if you're new to the format, we'll first paint the picture as to what is happening across the country more broadly, some things to look out for. We'll focus on going through each of the capital cities one by one to see how they are actually performing from a numbers point of view. This month, I also have some opportunities and some risks that I want to call out for each of the specific areas that I will go through. And then at the end, we have specific areas to focus on based on your budget. So this month we've got budgets under $600,000 and some specific areas to focus on and why. And then we also have budgets over $600,000, again, areas to focus on and the reasons why we think they might be worthwhile investing. If you get some value out of the episode, appreciate a thumbs up. Consider subscribing if you are looking for regular property investing content. In Australia, we do it every single week and every single day. In fact, there's something going out. Also, little plug, follow us on social media, Instagram at Smash Property Investing, where there's tons of content coming out all the time, especially leading up into the new year. So let's dig into it. What is happening across the Australian market now? More broadly, the property market is very, very strong at the moment. This is the third consecutive month with extremely strong growth. So across the country, we saw prices rise about 1% in November. And some of the markets that are performing really strong right now, and I'll go into the list in just a second, you will see Perth and Brisbane are extremely strong and performing extremely well. But the market reality is you've got vendors that aren't really willing to negotiate too far or too hard on price. So we're seeing a lot of people potentially overpay in a lot of these areas. You've got negotiation that's quite limited, all right? And you've got competition that is very high. So whilst the market is performing very well, we've got to be careful about the type of assets that we're selecting in those markets. And I'll get into what we can do in just a second. Sydney and Melbourne are much quieter from the data, and you'll see that appear on screen in just a second. We'll get through it. But the reality of it is those markets have really, really good buying conditions right now because we've got vendors that are kind of open to negotiation, vendors that might be willing to sell less than their asking price. And as a buyer, that's the sort of market that we want to get into. And I've got some areas and types of properties in Sydney that we'll focus on, and I'll get to that in a second. Likewise for Melbourne, which we'll cover. More broadly across the regional markets, they are performing very well. They're very consistent. They're very stable. Now, the reality is they do move a little bit slower, right? And we can't expect a regional market to outperform a capital city. It's not how things normally go. I know that has happened through certain points of time in the last maybe few years, but they are reliable. They're performing just a little bit slower than the capital cities. We also have a little bit of a change in the interest rate sentiment, right? Like I was sort of reporting a few months ago now that the expectation of the cash rate futures was that interest rates would start to come back down around about now, which is not happening. As you may well have seen, the inflation is a little bit stickier than what the RBA would otherwise like to see. And so rates at the moment look like they are going to be around what they are currently. So that means our borrowing power is not going to increase anytime soon. And that does have a bit of a impact on the market, right? Because as the rates were coming back down, people that weren't able to were thinking about getting back in, and people that were already in started having a borrowing capacity increase. That sort of tapered off a little bit, but market's still running hot, as we'll go through the numbers in just a sec. I also want to call out APRA is going to be tightening some of the lending conditions in early 2026, which is going to see some investors start to prioritize higher income or high yielding properties and make sure that we're buying in areas where there is strong rental demand, so we minimize those vacancy rates. We'll keep an eye on that one and the impacts of that APRA tightening in probably in February 2026. We'll see how that goes. Now, across the market, you've got listings that are still pretty tight across most of the capital cities. So this is further lowering supply, which is encouraging further growth. It's just sort of adding a bit more fuel to the demand fire that we're obviously seeing. I am seeing units become much more of a focus, not only for owner-occupiers, but also investors as well. We've actually bought a few units in places like Melbourne, actually still buying in some parts of WA for the right investor at the right price. It's got to form part of the right strategy, but I'm seeing a lot more demand start to come back for those types of properties, particularly in areas where they are well positioned, like close to the beach, maybe close to the city, close to employment opportunities. They're actually doing quite well. And I might share an example of an investor. I think he does watch this. He's bought now 2 properties with us. We just picked up a property for him in Melbourne, a unit in the Frankston sort of LGA, really close to the water. We picked it up for $555 and change. We've got a valuation of $580 and we've only just settled on the property, right? So it doesn't always have to be, I know I always sort of preach about it, house, big block of land, blah, blah, blah. It doesn't always have to be that way. You can still get some amazing results in terms of equity growth and also a good yield by purchasing units. And I'm starting to see that make more and more sense in the recent times. So let's take a look at the capital city performance. This is, one of my favorite sort of segments of these property market updates. If you watch this consistently, you know why. I've ranked these in order of growth for the month of November. And as you can see, Perth is leading at 2.4% growth in the month. And if I put that in dollar terms, that's roughly $21,000 in terms of growth in 1 month alone at the median level in Perth. So it's absolutely steaming away. Annually, Perth is up 3.1%, which has had a bit of a recovery in the last few months. Probably the last 2 or 3 months, it started to pick up quite significantly. Median value in Perth now sitting at $914,000. Brisbane up 1.9%, which in dollar terms is just under $20,000 in growth in 1 month at the median level in Brisbane, which is insane. Annually up 12.8%. The Brisbane median now sitting just a little over $1 million, which is crazy to think that for Brisbane, which was once considered, and Perth, regional towns at one point in time, not too long ago. Adelaide up 1.9%, which in dollar terms is just a little over $17,000 in the month, which has also had a little bit of a recovery. If you watched these recently, you would have seen that Adelaide sort of dipped for a little bit, sort of starting to pick back up again, 8.2% annually. Median value $891,000. Darwin is up 1.9%, $11,000 in the month. Annually, it's up 17%. So Darwin's been charging for a long time. I'm not buying in Darwin. I don't believe it is a market for long-term stability, which is what a lot of investors we work with are looking for. It's sort of the boom and bust sort of cycle. We're sort of in that boom phase at the moment. Median value in Darwin just sitting under $580,000. And Hobart also a little bit of a recovery. It did sort of go backwards earlier on this year, up 1.2% on the month, which is $8,000 in terms of a dollar change in the month of November. Median value in Hobart sitting at just over $700,000. Annually, only up 4.7%, right? So Canberra's an interesting one. It's up 1% in the month, which is a $9,000 dollar change in the month of November. 4.2% annually, and $892,000 median value in Canberra at the moment. Now, Sydney and Melbourne, you can see the data is saying that they have had the slowest growth out of all of the capital cities. Sydney up 0.5%, which is just on $6,000 in terms of change in the month. Annually up 5.1%, median value 1.27%. I'm going to tell you in the next segment which what type of assets I would be looking at in Sydney, where some good buying opportunities are in terms of the exact suburbs. And I'll tell you why. And a little bit of a hint, it might be some unit markets as well. Melbourne is still growing very slowly at the median level, up 0.3% in the month, which is just on $2,000 in terms of value change. But there are markets in Melbourne that are moving insanely much quicker rate than what you're seeing here in the data. And this is a great example of not taking data as, for example, we look at Melbourne right now, you'd be like, well, Melbourne's crap, right? It's not growing. It is, and it's growing quite quickly. This is where asset selection is extremely important, and this is where location due diligence is just as vital as the asset selection. And I'll go into some things you can look at in just a second. So love that snapshot. Perth, Brisbane leading the charge, absolutely steaming away. And like I said in the intro, they're great markets, but there are lots of people overpaying, lots of people not able to negotiate, lots of people, it's basically first and final offer that's going through. Whereas somewhere like a Sydney or Melbourne, vendors are maybe selling below asking price. You also have a bit of an opportunity to negotiate as well. And with that, get yourself a better deal. So it's not always chasing the market that is growing the quickest and the fastest. I've said it time and time again. It's about going where you can get the best deal and going where everyone isn't. So what's driving the market, which is always important to know what is going on here. And it should be no surprise to really anyone. The biggest driver is population growth, which is fueled by net overseas migration. We've got low rental vacancies in pretty much every market across the country. You got a lot of investor activity starting to tick up, particularly in Victoria and Melbourne. Units are regaining a lot of popularity, and we'll touch on those areas in just a second. I keep saying it, but we'll get there. And an interesting one is that you've got banks now starting to compete on interest rate pricing. So I've seen some investors that have come through with some very, very low 5% rates, which are amazing. And it's slightly improving borrowing, getting a little bit more competitive, and it's just allowing people to maybe go and get that other property, or maybe allowing people to get into the market for the first time as an investor. Typically, as we have always covered, the supply is still constrained, right? So you've got builder insolvencies, you've got high construction costs, which is still there. I had one of our clients, he was looking to build a granny flat, and he got quoted, not through us, but one of the builders in Queensland, $250 grand to build a granny flat. And I said, mate, like that ain't worth it. Like the numbers don't stack up at that sort of price, right? So construction costs are very, very high, particularly in some markets. You've got slow planning approvals still in play. You've got fewer projects commencing. You've got developers land banking, and all this is just really artificially constraining the supply. Now, what we're seeing on the ground outside of the data is that Perth and Brisbane, as they have for quite a while now, are having properties sell before the first open home. They're having properties sell within the first week of being on market. Right, you're having properties sell way over asking price, and a lot of times it's best and final offer, multi-offer scenarios in Queensland, etc. And it's good if you're not too concerned about getting a property at a good price and you just want to get into the market. Never would really recommend that. So for the average person out there doing it yourself, those markets are very competitive, and you've got to be very careful about making sure you're buying the right asset at the right price. Now, obviously, we're buying in these markets and we are buying some good deals, but you've got to kind of know what you're doing. I wouldn't recommend, first-time investors trying to tackle these markets alone, particularly Perth and Brisbane. Now, Sydney and Melbourne, on the other hand, I'm seeing a lot of activity, particular in Sydney in the unit market in that sub $1 million range. A lot of activity around the sort of middle rings of Sydney, and I'll go into those suburbs in just a second. But the unit market is moving much faster than the headline data I just called out a second ago. Sydney growth 0.5% in the month at the median level. The units are moving much, much quicker than that. Days on market disappearing, and sales volume rapidly increasing again, particularly in that lower sort of 1 million sort of price range. Melbourne quite similar, although a little bit more spread out. And also a little bit different in Melbourne, given the price difference between Melbourne and Sydney. is sort of spreading the buyer activity across houses, obviously units, close proximity to CBD, but also those investors with budgets sort of, under the 600K, they're also looking at freestanding houses in regional pockets, sort of 2 to 3 hours outside of the Melbourne CBD. Regionals, soft spot for regionals, they are performing very well. Vendors in regional markets, in certain regional markets, have realistic pricing expectations and are often accustomed to receiving less than what their asking price is, again, depending on the market that you're going into. And I'll touch on some markets that I think we want to pay attention to and some markets that we want to avoid. So looking at some opportunities, let's get into the detail here. So Melbourne, look at it from a numbers point of view and you go, well, this is crap, right? It's not growing. It's had very low sort of growth over the last few months. Why I don't want to buy there. But we need to look at it and understand that each property market moves in a cycle. So Melbourne is what we would call early cycle. It's, in my opinion, mispriced in certain markets, and it's very negotiable, which is what we want as buyers, right? So why Melbourne works at the moment, it does have strong momentum reappearing in certain pockets where we're seeing buyer activity start to pick up. We're seeing, price growth, we're seeing rent growth, and just overall demand. Units and houses, in my opinion, are undervalued for Melbourne, but also comparing it to other capital cities as well, particularly Sydney. The vendor power dynamic between a buyer and a seller is switched to the buyer's favor. All right. And so what I'm seeing on the ground is your days on market is typically between sort of 25 to 40 days, which is great for us buyers. It gives us time to negotiate. It's obviously going to put a bit of panic into the seller's sort of side of the fence to go, hey, can I actually sell this property? If an offer does come through and it's reasonably good with okay terms, there's a better chance of them accepting it versus a Brisbane where this is going to tell you to get stuffed. If your offer's not where they sort of want it to be, someone else is going to come in and willing to pay that sort of price. Melbourne obviously is on a lot of podcasts, a lot of content, and the investor space. It's funny, there's investor sentiment or investor activity, I should say, increasing in Melbourne, but there's also a lot of people that are very hesitant about Melbourne, and I understand why. They're hesitant from a stamp duty perspective, they're hesitant from a land tax perspective, they're hesitant from a government perspective, and I completely understand why. So it's going to be interesting to see how this actually plays out. I've always said I don't see it being the same frenzy as what Brisbane and Perth once were in the recent times, but I do see it obviously increasing on where it is currently today, largely fueled by net overseas migration into Melbourne and into Victoria as a whole. So it's going to be very interesting. We'll keep an eye out, obviously, as the weeks and months progress. I'll keep you guys updated. Now, some opportunities with Sydney is Sydney has a very, very strong wage base, right? Income in Sydney is generally speaking very good, comparable to other parts of the country. Again, Sydney's data looks like crap, right? It looks like, why would I buy there? Nothing's happening. But again, Sydney is in an early phase of its current growth cycle that we're on. There is clear demand surging in Sydney, very much under that $1 million mark. So obviously the western suburbs in Sydney, not that there's too many suburbs under $1 million, but there's obviously a unit market there, which you can get well under $1 million doing very, very well. You've got extremely strong rental demand in most parts of the city. You'd be hard pressed to find a property that's sitting vacant for an extended period of time. And if it is, it's largely due to the landlord expecting a higher than market rent. And you've got a bit of momentum sort of building back up in the Sydney market. So what we're seeing is good stock in Sydney is starting to sell before open. Buyers are starting to need to act a lot faster than what they were. And in the unit market, we're seeing a lot of boutique style unit blocks perform very well, particularly when they're well positioned, like got a really good location. The sort of slap them up, build them real quick sort of apartment blocks, I don't love them. I don't encourage people to buy them as investments. We always go with the sort of red brick four pack of units style of unit, and like I said, those ones in well located suburbs doing very, very well. Some more opportunities. is Brisbane. If you know me, you know I've got a soft spot for Brisbane. It's Mr. Consistency, right? It's the consistency king. It's got 12 to 18 months now of very, very consistent growth. Hasn't showed any signs of really slowing down. You've got extremely low supply and extremely high migration, particularly from net interstate migration, people moving to Southeast Queensland, Gold Coast, Brisbane, Sunshine Coast. And me being one of the many people that are moving up here, and it's clear to see why. On the ground, we're seeing days on market in a lot of cases for really high quality properties selling within a week, right? Under offer within sort of 7 to 18 days. It's very, very common to see that. What we're seeing is multiple offers on one property. Sometimes, 10, 15, 20 something offers on the property. So it really is best and final, and it really is who's got the biggest budget sort of is winning out in a lot of these scenarios. Contracts are getting signed quickly. But we also need to make sure with Brisbane in particular, the flood risk and therefore the insurance risk of these properties, you need to make sure you get the flood checks done and checked prior. Although with the new laws in Queensland, your seller side should be providing you that disclosure. But another big one is the building inspection or the building and pest inspection. Now, obviously, Queensland style properties, particularly the really old ones, sometimes it may not have been maintained properly. This can add an element of risk to you as the buyer. So best to get it independently inspected. Do not rely on the seller side to give you a building and pest inspection. Rather pay the $500 to get the property inspected correctly so you know what you're in for before you go ahead and buy. Some other opportunities is in regional Victoria, and I've mentioned this before. It is still very affordable. It is still in the early part of its growth cycle. Why we're seeing this working and growing in some markets, we're seeing a rise in sales volume. A rise in sales volume is normally, you see that before, massive price growth in some of these markets, followed by tight rents across a lot of the key regional pockets in Victoria. And quite obviously, it is underpriced when you compare it, particularly to Melbourne and obviously to other capital cities as well. We're sort of looking anywhere from the sort of low 400s into the low 600s in some of these regional markets. Days on market, we're sort of seeing in that sort of 25 to 50 days, depending on, again, which region in Victoria you're really looking at. In most of the markets, the vendor negotiation is very possible. We're frequently picking up properties $20, $30, $40,000 below the asking price of the vendors. Not always, but in some cases where we're able to do that, it's been amazing for the client. And there's some really nice low set brick, big block of land type of properties available, as well as some very nice, tidy units, high yielding, good locations, all these sort of things in regional Victoria. So it is affordable. And like I said, it's at the early stage of its market cycle. Now, some risks that we need to look at, and I've mentioned this before, is regional Queensland. Now, whilst regional Queensland looks good on paper, right? Regional Queensland, you look at the numbers and the data and you're like, wow, it's had a shitload of growth. Days on market is very low. There's lots of sales activity, all these sorts of things, but it's all happened, right? It's all, you should have been in Queensland, 1, 2, 3, 4, 5 years ago, because you would be reaping the reward now. The smart money, like we just talked about, is moving into Victoria. Victoria is where Queensland was, 2, 3, 4, 5 years ago. So what I'm seeing in regional Queensland is the vendor pricing is unrealistic for the most part. Again, I'm picking up some good deals here and there, but we're not predominantly buying in Queensland like we once were, sort of 6, 12 months ago. Days on market is starting to rise, right? You've got vendors that have been unrealistic with their price expectation. The property's now sitting on market for a little bit longer. The buyer depth is starting to thin out. Obviously, you've got less buyers agents buying in Queensland, so the buyer sort of concentration has sort of moved out. Again, adding to the days on market and the potential unrealistic expectations, because the vendor might be like, hey, my neighbor sold, for whatever price 6 months ago. I want to get something a little bit better now. Not really seeing it move as quick. Queensland as a whole, obviously higher insurance premiums for depending on the pocket that you're buying in, and obviously, as always with Queensland and a lot of other markets, really the flood risk in certain pockets is something to be aware of. So I'm not shitting on regional Queensland. I'm saying that a lot of the growth has happened. There are still some good deals there, but few and far between. You've got to be very particular about it. Again, some other risks to call out here is Perth. It's in the later part of its growth cycle. Like I just called out though in the intro, it's still got a lot of growth. It's got a lot of competition. So you got a lot of people trying to grab onto the tail end of the growth in Perth. There are some issues with the quality of builds in certain pockets, higher defect risk, some cracking, which is quite common in some of the builds. Negotiations, not really that possible outside of the building and pest. And a lot of areas I'm seeing prices just bid way over what I would consider a reasonable price for some of these properties in Perth. Again, I'm still buying over there, not a huge amount, but we are here and there depending on the investor and their risk appetite and what they're looking to achieve. But we're very selective about the type of asset, the location, and all the due diligence that goes on behind it. So as much as I love Brisbane and Queensland and I love Perth and WA, we've just got to be careful about the type of assets we're selecting in these particular markets. I will also call out some risk with Sydney and Melbourne. I'm not all in on Sydney. I'm not all in on Melbourne. There are risks that we need to be aware of as buyers entering that market. The biggest thing for me is on the fringe estates in both of those capital cities. There is a ton of oversupply, and oversupply is going to impact price in the sense of prices just staying stagnant for extended periods of time, right? So these sort of greenfield estates and all those new builds and all you can see is new houses as far as the eye can see. There's no scarcity value there. Like I said, it is oversupplied, and with that you have buyer demand a little bit softer than other parts of the city. So we've got to be careful with that. Now let's get into some areas that you can focus on based on budgets under 600,000. We'll tackle that first. Now, firstly, for me, for budgets under 600,000, there are a few opportunities in capital cities. Now, there are some unit markets in Sydney in which you can purchase under 600,000, you're talking some pretty rough areas. Would I encourage that? Depending where you are on your investment journey, probably not for your first investment. So I'd be looking at these markets for freestanding houses to build up yourself a bit of equity, to build up yourself a few options later down the line in terms of development potential, if you so choose to do so, but also building up some options for yourself for manufacturing growth. We always talk about it, manufacturing a rent increase through properties like this. So regional New South Wales, you can find markets in the sort of 480 to 600K mark with reasonably good rental yields in the 4% plus range, sometimes over 5% depending on where you are. Now, regional New South Wales is a pretty stable, steady market. I'm not expecting, double-digit growth in the next sort of couple of years. I'm just expecting slow, consistent growth, and that suits some investors to a T. It also doesn't suit other investors. So I like the strong regional centers with strong tenant depth. We've got good, diverse local economies. We've got realistic vendors that aren't, expecting some stupid amount for their property. So areas like Albury, I know Albury's had some amazing growth. I feel like that part of the world is particularly because of the flow-on effect from Victoria. I do see increasing in value, slow and steady over the next little while. But also Wagga Wagga, I've spoken about it for a while now. Wagga Wagga is a great, in my view, undervalued part of New South Wales, and some really, really good prices in that particular market. You want to be careful on the northern end of New South Wales, Tamworth, Armidale. There's some okay deals there. It's obviously had a lot of growth, but you want to make sure that the play matches. So you want to make sure that the purchase matches the play that you're looking to do, right? So am I looking for a balanced cash flow and growth play? Maybe a good idea. If you're after a yield play, probably not the best at this point in time. We are looking now at the regional Victoria market as well. Now, this has been in my sort of recommendations for a bit of time. The regional Victoria sort of in that 430 to maybe sort of 580 range. It is a rising market, and there's obviously different, suburbs or locations or LGAs in Victoria that are kind of moving at a bit of a different pace to one another. So I like to look for tight rentals, rising demand, and good buyability in markets like Wodonga, Shepparton and Mooroopna, although just with that location in particular, there is a bit of flood risk there. So make sure you get you do a flood check prior to even putting down offers. Parts of Warrnambool, love it. There's some amazing deals we picked up for clients. Sale, Bairnsdale, Colac, parts of Geelong, parts of Yarrawonga, all doing amazingly well. I mentioned in other parts, other podcasts, Mildura for me is an absolute no-go zone. Ballarat, Bendigo, still buying there, but again, you just got to be careful about the asset you're selecting and the price that you're paying, because there's some parts of Bendigo, Ballarat where vendors are starting to get a bit unrealistic with their price expectation. You're getting a lot of competition from other buyers and buyers agents all bidding on the same property. And as soon as that starts to happen, you then lose the ability to negotiate and lose the ability to find good deals for yourself. So again, doesn't mean to say don't buy there. Just be careful about the sort of state of the market in those particular areas. So regional New South Wales, regional Victoria, under $600,000, particularly freestanding houses in these markets. I love them a lot. If you're after a bit of a yield play, I haven't got anything listed here, but I love regional markets. I love regional units for a high sort of yield plays in these particular areas. Also, don't sleep on finding something, for example, in Melbourne, particularly a unit under that 600K mark if you're looking for a bit of a stronger yield. I've done that personally myself. Asset selection, really important. Particularly in Melbourne, there's a lot of cladding issues with some of the apartment blocks and stuff like that. So just got to be careful with your DD on that sort of stuff. Now, where to focus on budgets over $600,000, and we've got a lot more flexibility now that opens up in this particular world. So first for me is the Brisbane Middle Ring. It's always been on here for a while, right? So the Brisbane Middle Ring, you're probably looking comfortably in the sort of 7, 8, high 800s in that Brisbane Middle Ring. When I'm talking about freestanding houses, I know you can get stuff a lot cheaper. I know Ipswich, you can probably get something potentially under 700,000 outside of a flood zone. But here's what you target. You want strong owner-occupied demand areas. You want areas where there's good, solid incomes of the people living in the area. You want areas where there's a bit of a tighter supply. So some key areas, Chermside West, Everton Park, Stafford Heights, Aspley, Strathpine, Warner, Bray Park, Shayla Park, all those particular areas in that sort of middle ring, like I mentioned, in my opinion, represent really, really good value, good buying, particularly leading into the Olympics in several years' time. I love the Southeast Queensland sector as a whole, anywhere from Sunshine Coast down to the Gold Coast, getting into that market under $1 million or even under 900 if we can really get there. Again, depending on the asset, really, really great value. I'm buying in Brisbane a lot, big advocate for it. And I think it suits the investor that obviously has the budget to get into those markets and is not too concerned about yield and is really focused on growth. Because what I'm seeing in those markets is price growth is increasing rapidly, and with that, the rental yields are deteriorating quite quickly as well. Because as you obviously know, the rent is not going to catch up as quickly as the price growth. It will eventually, but right now yields are pretty low, pretty shit in Brisbane, but great growth. Where to focus over 600K, the Melbourne Middle Ring, right? So we're looking in Melbourne Middle Rings between sort of 6 to 800K mark. It is in obviously that recovery part of its growth cycle. Now, we love areas like Frankston, Sunbury, Glenroy, Hadfield, Oak Park, Altona Meadows. You've just got to allow for stamp duty. It is a lot higher than most of the other states, obviously depending on the price point. You've got to allow for land tax. And obviously you're building a pest on the older style homes is critical to get. That doesn't mean don't buy them. I love older style properties over new ones. We've just got to get a quality building and pest inspection, and don't be shy to negotiate when things come up, or if it's not suitable for your risk appetite, pull out of the deal altogether. So those are some of the areas where you can look at in Melbourne particularly. I love Frankston, got a bit of a soft spot for it. And love that. Sydney units. Now the Sydney unit market, we're sort of looking in that 650 to 950 range. Again, in that recovery part of its growth cycle. So like I mentioned earlier, you want to focus on those boutique style apartment blocks. So forget all the new high-rise crap. We want to look in areas like Marrickville, Petersham, Summer Hill, Ryde, Lane Cove. Janali, Gymea, those sort of areas where there's good it's good location, maybe close to lifestyle sort of stuff, close to the water, close to the beach, close to the city, close to public transport, all those sort of things that, make a unit good in the sense of its livability. Those are the kind of areas that you want to focus on. Again, scrap all the high-rise stuff, scrap all the new stuff, go with the older style of property. Just look out for obviously defects, get a review of the body corporate and all the things happening in the complex, and also just be aware of some insurance risks as well. So basically, do your DD before you put through and purchase in these particular markets. So those are some pretty, there's some pretty detailed and hot areas that I've just given you there. So definitely have a crack and jump online and speak to agents if you're looking in any of those particular markets. Obviously, if you need help cutting through all the crap that's out there, you want to find a property at the right price, you want to have it all done for you, that's the service that we provide. There's a link if you're on YouTube to book a call. That goes to my team. If we can help you, we'll explain how we can help you. If we can't, like I always say, we'll tell you, hey, sorry, we can't help you. We're not going to be the right fit. So look, based on the current data and the on-the-ground buying conditions, 2026 is going to be a year where strategic market selection is going to be very, very important to get the market right? To get the market right and to get into that market at the right price is going to be critical. So I'm going to be interested to see how Perth and Brisbane sort of play out over the next sort of 12 months. I wouldn't be surprised if Perth maybe starts to taper down. Brisbane potentially slows down once it starts to get, closer to well into that $1 million sort of median level. Others like Melbourne and Sydney, I'm expecting to see a lot more growth. Melbourne more broadly across the house and unit sector. Sydney predominantly in the unit market. The housing market in Sydney is in freestanding houses is already cooked, and it's been for a long time. So the unit market, I would expect there to do quite well. Regional will continue to provide great affordability, great access, really strong yields, steady growth, albeit maybe just a little bit slower than some of the capital cities that I have mentioned. So the investors that are going to do well are going to focus on the fundamentals of buying property, buying it at the right price, buying it in the right market, and buying it with a cash flow that is suited to you specifically as the investor. Getting that is going to be absolutely right. Obviously, we want as high quality asset as we can possibly get, and don't mistake newer finishes with high quality. That's not what I'm saying. High quality means a solid build that could be done from the 80s, right? I've got lots of properties built in that time period that, in my opinion, are far higher quality than some of the newer stuff we've got out here today. You want to assess risks that you see for yourself clearly. Before you put in offers, ideally, you understand and you accept the risks of buying into some of these markets. The great investors are going to be patient, right? They're not going to rush in and try to get into a market just because. They're going to be targeted, they're going to be disciplined, they're going to be specific with it, and above all else, they're just going to avoid being emotional, right? I always say, just leave with property investing or investing in general, leave your emotions out of it. It's got no place in investing. Don't be reactive in your decision making. Be targeted, strategic, specific. And 2026 will be a great year for property investors if you follow those things that I have just mentioned. So that's all we got time for today's episode. I appreciate you watching and getting this far. If you got some value out of the episode, appreciate a thumbs up. Consider subscribing. Until next time, I'm Nick V. Thanks for watching. Catch you soon.